How's it going? So, welcome to another edition of Instagram Live. Our Way Home is bringing you stories, real stories of home ownership. The goal is to empower others to build wealth through real estate by sharing other people's stories of home ownership. But today, okay, so we're going live. We're live. Okay. Today we have special guest Andrew Keller, loan officer here at U Mortgage out in Lehigh Valley. Lehigh Valley, right?
That's right. Thanks so much for the warm introduction. Always a pleasure to be here with the wonderful Nicole Perino.
Yeah, you got it.
The first one was right? Okay, perfect.
Yes. Good. And you're going to be seeing a lot more of us, everyone here that is tuning in, because we're going to be doing much more live streams. Oh, Ian's there. He got it. He figured it out. Okay, awesome. So today, every other week we talk to home owners who have bought homes and hear their stories. But today we're going to actually talk to you about the process and what it looks like to buy a home. How the heck do you do it? We're also going to leave it open for questions. So anybody who is just tuning in right now, you're seeing this on Instagram, just pop your questions in the chat and we can answer them while we're going through this presentation or just at the end. We're going to leave it very casual and open-ended. So let's get into it. All right. So today we're going to talk about our goal for you, our vision as a company, U Mortgage, Andrew and myself, loan officers, helping you get mortgages, understanding your real estate that you're buying. How can you get started? Like, what is even the first step that you take? And then we'll get into Q&A. All right. So our goal for you, as with everything, is we want you to feel educated, empowered, and ready to go, and ready to take that next step. Our vision here at U Mortgage, Andrew, do you want to talk about a little bit about this? You've been here for a while, so our vision at U Mortgage. Tell everybody what it is and why we kind of stand by that.
So certainly it's very, very, very straightforward here, creating life-changing opportunities through homeownership. There's so many wonderful benefits to being a homeowner, and it's our job as loan officers to really guide and educate, like you were saying, to get somebody to accomplish their goals. Like, there's so many moving parts with that, and it's super important to have a professional advocate by your side throughout this process.
Very true. Yes, and we truly believe that as homeowners ourselves. And just what we do every day. Yeah, helping people build wealth, change their life. Okay. This is an important one. Understanding your real estate. So first, before we even move through the steps or how to do it, how to buy a house, what, let's just understand what type of asset are we purchasing here? Is it a home that you're going to be living in? Or is it a property that is just a real piece of real estate that you're going to own and maybe make income from? It's going to cash flow. Somebody else is going to live in it. So why is that important for people to understand, like, before they even go through the process? Why is this important to understand?
Why is it important to understand what your goals are going to vary depending on what it is that you're trying to purchase. So you may look at something a little bit differently depending if it's going to be your forever home or if it's going to be perhaps an income producing property or even a second home. So that's a big part of what we do, is understanding what your goals are and how we're going to accomplish that.
Yes, that's right. And this another thing that matters to people is like the down payment requirements for a house that you're buying to live in with your family versus a house that you are buying as an investment property. It does make a difference. What products does AK put in the hair?
We can't give away all the secrets. All right. That's confidential information.
Confidential information. If you get the pleasure to work with Andrew as your loan officer to help you get a mortgage to buy a house, you might find out those secrets.
We might make an exception there. Yep.
Might make an exception. Okay. So yes, understanding the real estate, right? The goals, like you said, the goals are different because first of all, how much money you're required to put down is going to be a difference. If it's your house that you're going to live in with yourself or your family versus a house that you are not living in, there are different requirements. So just keep that in mind. And one thing I will say is like the buzzword for everybody, especially young kids, you know, it's like, ooh, I'm going to buy a duplex. It's going to be an investment property. But really, you know, they're really it's their primary residence, right? So like when people are buying a duplex, they're going to live in it. Now, yes, it's a house they're going to live in, but it's also a property that they're investing in. So it's kind of like a complicated situation. And a lot of people want to invest in duplex for that reason, that they can get a lower down payment, but they can also make money a little bit from it. It's a good
For
investment.
sure, you're always going to get the best terms on a primary residence. You know, whether that be a duplex or a 4 unit, whatever it is. You know how the property is described, but that's something that we help you out with as well.
Yes, exactly. Okay, so next, understanding your equity. What is equity? This is another sort of thing people talk about a lot. What does it actually mean? Equity in your home. It's the amount that you own versus what you owe, or what the bank or mortgage lender owns, part of your house. So you can see this little illustration here, the purple shading. That's like your down payment. So you put money down, you put 3% down, 10% down, 15% down, whatever it is. That's percentage of house that you own, and that's your equity. The rest of it, the bank owns it. That's a pretty simple one. Okay, understanding the mortgage payment. So tell everybody what goes into their mortgage payment. Like when they have a rent payment, they're just paying, they're paying their rent every month, but it's not broken up into different, categories. Now, when you own a house, you have one holistic payment, but what are the pieces that go into that monthly payment?
So we break it down typically with this acronym. So PITI. So that's going to be your principal and interest, and that's the portion of money that you borrow. Okay. So then you have your your mortgage insurance as well. That can be a part of that. Your taxes, your homeowner's insurance, all those things combined. That's going to create That's going to create your PITI. Sometimes you're going to have maybe like HOA dues. That's not really in the acronym, but that's also going to be a part of your mortgage payment per se, or your qualifying payment, I should say.
That's right. That you might have association dues if you have a condo, or even like a new construction like house that's part of you have to make sure you talk to your real estate agent and say, hey, is there any other fees that I have to pay? Because that will be, not only will that be included in your monthly payment, it will also affect how much you qualify for.
Correct. Yeah.
Now it's adjusting, your monthly payment. And we know the mortgage insurance, you're only going to have that if you put less than 20% down, which let's just say most people are doing that, putting less than 20% down. You don't have to put 20%. And mortgage insurance, like I have it on one of my houses, it's $45 a month. It's not a lot of money.
A lot of times people hear that word mortgage insurance and it's like this, boogeyman, whatever. It's really just the amount of money that you can save by putting down less money and then having this marginal payment on top of that. Like, it's really something to consider. Again, it really depends on your goals, but it's definitely a conversation to be had.
Definitely. Yes. And we can like talk through that. How's it going to affect your bottom line, your day to day? Like, is saving $5,000 in your bank account so you can like go buy that new furniture, or just have extra cushion of savings, better for you to do that and just have the little bit of mortgage payment, which mortgage insurance, which by the way, it will fall off anyway. Once you make, that's the thing about owning a house. You make those payments every month. You're chipping away at that equity, and you own more and more and more. And as soon as you own 20%, you don't have mortgage insurance anymore.
100%.
So that's the best part. Something that people have asked is like, oh, can you actually like not have your taxes and insurance part of your mortgage payment? Yes, you can. It's not the popular way to do it though.
So, I mean, it depends on a few different things. It's definitely not the popular way to do it. And also, if you're a first time home buyer, you might just want to consider doing it so you don't have to worry about it. You don't have to think about it. The money goes in an escrow account and then the servicer is going to pay that for you. But it depends on the loan program. And kind of depends on, sometimes, depending on your lender, they might have different overlays of what they require. But,
Yeah.
It's
possible, but not the most, not the most advantageous. Honestly, it's great to just have everything be paid in one. You don't have to think about it. It's automatic payments every month from your bank account. And, you know,
I know why I prefer it. I don't want to think about it. So,
me too. I don't want to have to go.
somebody, there you go.
Who wants to have a whole nother portal you got to sign into? I mean, we have enough passwords in our lives. We don't need more things.
Yeah, for sure.
All right. So now we're getting into the process piece of it, actually. So down at the bottom of the screen there, or in the middle, you know, that timeline at the bottom, you're going to see, oh, sorry. We should look at some questions before we get into this. Is it always a ding to your credit to just check what you can get pre-approved for? Oh my God, great question.
Absolutely not. The way that we do things, here at U Mortgage, we do a soft pull, and the soft pull is going to allow us to kind of work up the application and see where you stand. Depends on the scenario. Sometimes we're going to have to do a hard pull, and you have to think about credit. Like when it comes to credit, the credit inquiry is going to be the least impactful of anything that you do with your credit. You really have to look at credit like a seesaw. So how many good things do you have compared to how many bad things per se? So the things that are going to affect that the most are, your utilization, your credit history as a whole, your on-time payments. Like these are the really important things. When you're actually shopping for a mortgage, when you're trying to get a mortgage, the inquiry is something that's going to be very minimal, and it typically is going to recover very, very quickly if it has any effect.
Okay, that's a good. Now, maybe we should mention this to people that are thinking about, credit. What are some of the like bigger factors that can affect their credit, like out of the pie chart?
Out of the pie chart. So again, utilization is a big part of it. So when you're,
what does that mean for people?
Exactly. So what I mean by utilization is whatever you have a credit card, suppose the limit's $1,000, $2,000. To have optimal credit, you want to keep that utilization under 30%. So $1,000 limit, try to keep it under $300. Of course, make your payments on time. You don't want to be late. You have to use credit responsibly. And then the longer that you have those trade lines, those credit cards open, that's going to build your credit history. And that's really what they want to see. Like how long have you been using credit, and how have you been using it responsibly as well?
That's right. So a seesaw is a great analogy. Like it can tip the scales. Like, it's not like black and white kind of cut and dry. It's just, there's things you can do to affect it. Like pay down those balances. Is that actually going to, another important thing, a tool that we have access to here is the credit simulator. So before you even go spend money to pay down balances or pay off collections or do all these crazy things with your money, we can actually simulate the effect of your credit score and say, hey, if you do this over here on this, is this going to affect it? Yes, it's going to bring you up to this. Okay, cool. Let's go with that game plan. Okay. Oh, one more question. What is the minimum down payment if you buy a 2-unit, but you live in one? So you have a duplex, you buy it, you're going to live in one, but rent out the other one. What's the minimum down payment?
So always when you're doing a primary residence, like I was saying before, you're always going to get the best terms. So there was a recent update where you can put 5% down on a duplex. So it really is kind of affordable. Now that's if you're going conventional. If you're going FHA, 3.5% down. So very little out of pocket to get into an opportunity like that.
That is great. That's why people love the whole duplex thing. But so it's great. You can only put 3.5% down. But let's say, like, people sometimes ask about this too. Like, you can't really trick the system here. Let's say you're like, oh, well, I'm going to buy this duplex. And like, yeah, I already have a house where I live, but like, oh yeah, I'm going to live there. Like, nah.
Correct. Yeah.
Now you can't put 3.5% down. Why?
Well, so it really comes down to everything has to make sense to the underwriter. Like, mortgage fraud is not something that we're going to do, that we engage in at all. So it needs to make sense. So if you own a house, does it make sense for you to go from your single family home in a nice neighborhood to a duplex? It's not going to make sense. So we just have to make sure that we're following things, correctly and accurately. And again, we're here to guide you through that.
Yes. And then the reason you have to put more is because that now becomes like an investment property.
Yep.
Like the very beginning slide, we said, is this a home that you're living in, or is it an investment property piece of real estate? And it becomes a property because it's going to make you money at this point. So you need to put more money down, more skin in the game. to be able to borrow the money because you're not living there. It's a little bit more risky for the mortgage lender at the bank.
For sure.
All right, so going to the timeline here, you found a house, you've gotten pre-approved. We talked through all of this. You know how much you can afford. What's your monthly payment? You found the house. You got your offer accepted. You're signing everything. A lot is going to be happening. It's a stressful time. It's important to have a team that you trust because you're going to be talking to these people a lot. Your real estate agent, your mortgage lender, you're going to be talking to these people almost every day for 30 days because a lot is happening. It's coming at you from all angles. So you get that offer negotiating with your real estate agent. You're negotiating, okay, we want to pay this much. They want this much. You land on a number. You get that contract signed. Within the first less than a week, like maybe less than 5 days sometimes, we're ordering that home inspection right away. So you're on track. Like your realtor's going to want you now, unless you waived it, but usually you're going to get that home inspection. And why is a home inspection important for people? Now, it's important that it happens within those 5 days because usually in your contract, you only have so much time to get the house inspected and for you to review that report and then ask the seller for things that are needing to be repaired, or you maybe want them to give you money back for it. So you only have a certain period of time. This has got to move quickly. So it's not meant to stress you out, but just meant to keep you on track based on your contract. Why is it important? Like, why do people need to get a home inspection?
So it really comes down to, again, the comfort of the buyer itself. So as a first-time home buyer, you may not be familiar with, the details of a home or a house or construction or all those things that come into play. But getting a home inspection, like it's their job to go through every nook and cranny of the house. So they're going to be really an infinite informational resource for you for the status of the property as a whole. So if there's something that you may not be happy with or something that is, really wrong with the property itself, becomes a negotiating item. So you can decide, say, you know what, I'm okay with that, or you know what, we're going to need to be compensated, or it needs to be fixed, or whatever the case is.
Yes, we like that. So you want to see, every inch of the house, what's going on with it. You want to make sure the windows, the floors, the doors, the outlets work, like all these little things. You want to make sure you know what you're getting yourself into.
Correct.
Then we go into, again, staying on track here with your contract that you originally signed. It's going to have deadlines. So you're going to get that home inspection done. Now, the reason we get that done usually first and very quickly is because we want to make sure that you're okay with moving forward with the home as is, or at least you've negotiated some repairs. Because now you're going to start spending money out of pocket. Now, you've also spent money for the home inspector. You need to pay them. Maybe the home inspection costs between $400 and $800. So you already spent that on that guy to inspect your home, a professional. Now the appraisal again costs anywhere from $500 to $800. So you're spending money on these things. So you want to make sure you're on track with everything and you're understanding the why behind it. And if you need to cancel, we're not putting money out before we need to. So there's a strategy behind all of this. We want to protect you. Make sure you're not spending your money if you don't need to spend your money first. Now, after you get the home inspection done, you're all good with that. Okay. A couple days later, we can order the appraisal right away. You're going to pay for that, get it scheduled, get someone out to your property to look at the home. Now, what is the importance of getting the appraisal? This is required if you're getting a mortgage, but what is the importance of it for the home buyer?
So the appraisal is, again, it's another inspection, but one of the key differences here is the appraiser is going to go out there and he's going to evaluate the value of the home. So you may be the listing agent or the seller, they may think that their home is worth a certain price, but the appraiser is going to go out there and he's going to determine that value of the home. How is he going to do that? He's going to search around for recent comps and make sure that it's comparable to the area. Also, there is an additional inspection with that to make sure, basically most of the times it has to do with the integrity and safety of the property. They want to make sure that the property is sound and safe for you, and that everything's basically okay with the property for you.
That's very good. And the fun part is you get to see, what the value of your home is, which is awesome. hopefully a lot of times it's coming in like a little above value, or at least it's coming in at the same price point that you are under contract for, meaning the price that you're paying for this home, a third party professional appraiser is telling you that it's worth that much amount of money, which is very important. You want to know that going forward. And if it's a little bit more, like $5,000 more, okay, cool. You just got $5,000 of equity, which is your ownership in the property. You just own, that much more. So you have leverage for the future, which is cool.
There's nothing better than walking into instant equity.
Yes, we love that. And sometimes the seller or the listing agent doesn't know really what they're doing so much, and maybe they list it for lower and you actually negotiate a lower price than it's actually worth. Like it's farther off, and now that's great. That just means you got a discount, you got a bargain for this house. So it's an exciting time to get the appraisal done and see what it comes back. Then we get our loan commitment. So at this time, we need to have a lot more documents submitted to underwriters. They need to be checking your income, your assets, your bank statements, your employment information. They're making sure that you still have the job you said you had. You're still making the money you said you are making. And this is around day 15. Once the appraisal comes back, now 2 to 5 days, within 2 to 5 days further down in your contract, we need to make sure that mortgage contingency is satisfied. And we'll give you a copy of this. We'll give the real estate agent a copy of this. And again, it just means your documents have been verified by an underwriter. Now, there might be some, you have certainty at this point that you're going to get the mortgage. There might be some outlying conditions, right, that could still need to be satisfied. For example, you need to get a homeowner's insurance policy. That's a big one. So you might be talking at this point to Allstate, Progressive, whoever you have your car insurance with, Liberty Mutual. You're getting a homeowner's insurance policy. You choose as the buyer where you want to get that. So you're going to get that, and you got to send that policy statement into the underwriter as well. But at this time, they've reviewed all of the main documents, and you can be really certain that, as long as you don't do certain things, which we're going to talk about in the following slides, you don't change jobs, you maintain your same employment, you don't take any new credit or spend your money, you're going to get a loan at this point. And then around day 28, we have closing. So we went from day 1 to day 28. This is an average time, take you to close from the time you find the house you want to buy. And now, depending on what your agreement of sale says, now generally speaking, it's 30 days. So this will be anywhere from 7 to 15 days from the point until your loan closes, right? So day 15, your loan commitment. Then you have the title companies working through solidifying everything. And then you get to closing, you're signing all these documents, signing official, and you get those keys. The best day.
You're ready to stretch those hands out. There's a lot of papers to be signed.
Yes. Don't get crippled, or don't get cramp in your hand. So these are important slides. Okay. We went through the timeline, but during that very quick timeline, 28 days, a lot of big things are happening, moving parts. Setting yourself up for success, the buyer. Setting yourself up for success. Things to not do. Quit your job or move money around. Now, why should people not quit their job? Let's say, I'm going to buy this house, but I need to get it. I'm getting a new job, before you buy the house. Why is that not good?
So, pretty much all mortgages are based off the ability to repay. So how much, it goes by how much money do you make compared to, what are your debts and the new proposed mortgage liability. That's how we originate. And you need a qualifying income. So you can't quit your job in between this process. If you quit your job and you get a new job, what if your income changes completely? What if your pay structure gets changed completely? What if you're making less money? What if it's commission income? What if you decide you want to be self-employed? It's not a good idea. Or if you're thinking about it, make sure you talk to us first.
That's right. And I had someone last year wanted to quit their job and actually they had already started their own company, wanted to quit their job. I said, hold up, you buy the house first, and then you're going to quit your job and start with your company once you're settled in the new house. And it worked out great. She's starting her own company. It's really awesome. And everything was perfectly smooth. Now, if you are starting a new job, question here in the comments, if you're starting a new job in 60 days, can you buy the home now? If you're starting a new job in 60 days, can you buy the home now, assuming you're closing in this 28 to 30 day window?
Can you buy the home? Yeah, I mean, it's going to depend again on how your pay structure is going to be worked, but we're gonna want to see an offer letter, and then you're typically going to want to see a pay stub within that period of time, that right after you get that job. We're going to want to verify that afterwards.
Perfect. Okay. Now, if you are like, let's say you're closing on, like, it's day 28 and you don't start the new job for another month, like, then that's going to be fine. Like, if you're starting it after you close, that's fine. All right. Setting yourself for success. Again, what do we need to verify this income? So you're saying, like, mortgages are based on, you're getting a mortgage loan, a home loan to buy this house. It's based on your ability to repay. So how do we know, or how does the underwriter know that you're going to be able to repay this mortgage? Well, we need 2 years history of you working a job. It doesn't have to be the same job. It doesn't have to be the same company you work at now, but it does have to be 2 years of history. And then we're going to need 1 month of pay stubs. Why do we need 1 month of pay stubs? Well, we're looking at how much do you get paid every month, because you pay your mortgage every month. So we need to know how much do you get paid every month, but more importantly, how does that pay come in? So talk about that a little bit, like with the pay stubs.
So again, it depends how you get paid. It really does. Like, we have calculations depending on loan program, loan type. But again, we want to see how your pay is broken down and make sure that we have it calculated correctly, so that when it goes into underwriting, everything goes smoothly. Basically, what we're doing was taking all your documents, your pay stubs, your W-2s, and that's what's going to really verify to the underwriter that this is indeed what you're getting paid and how you're getting paid.
Yes. For example, maybe someone gets a base pay, but they get a lot of overtime.
Yep.
Sometimes, sometimes, but like, how much do you get that overtime? How often? Or do you get did you just start getting a bonus? But you have a base pay, but they decided, oh, this year we're going to give you a bonus. Okay. That's not really stable quite yet, because they just decided to give it to you like this year. We don't know if they're going to give it to you next year. So stuff like that. And the pay stubs just help us verify all those nitty gritty details in there. Whoops. Okay. Now, when it comes to credit, what do we not want to do when it comes to credit? So we've done the soft pool. Now we've done the hard credit pool, because they're buying a house. We looked at their credit. We've seen all their debts. What does the buyer not want to do during this 30-day time frame before they get the keys and close on the house?
So again, when we're originating, it's what are your debts compared to how much you're making. So if you decide that you want to go out there and you want to buy a new car, and all of a sudden there's a new, $800 mortgage payment, we didn't account for that up front because that wasn't on your credit report. But now all of a sudden it could throw things off. We want to keep things stable. We want to make sure that we have your approval 100%. And it's not a good idea to, make a large purchase like that in between this transaction.
Yes, that's right. Because it throws off what's called your debt to income ratio, which is just a representation of your debts compared to your income. So unless you got more income in this 30-day period before you close and get your keys, if you add more debt, now you're throwing off that ratio, and you could potentially not qualify to get the mortgage. And that means, now, this is good, not to like scare people, but you could potentially, you're opening a new line of credit, you're making large purchases, you're adding more debt than what we had accounted for originally. You could potentially not get the mortgage. Now, all right, you might say, all right, cool, fine. Like, I really wanted this car. I don't care if I don't get the mortgage. I don't want to buy the house anymore. Well, you have put money out. Remember, going back to the earlier slides, you paid for that home inspector to come out. You paid for that appraisal. You can't get this money back. You also put earnest money deposit down, which basically you said to the seller, you said, here, hold my money, because I'm definitely buying this house. Hold it for me until we close, and then I'll get it back. But they ain't giving it back to you now, because you messed up and you didn't get the mortgage. So you're going to be losing money.
Not to mention, where are you going to put that car when you don't have the house to put,
That's true. Yeah, exactly. Exactly. Where's the car going? So think strategically about these things. as you know, be patient. Talk to your advisors during this process. Last thing here, setting yourself up for success when it comes to your assets or money that you have saved. Total money needed. Thank you, by the way. Total money needed. So we talk about, like, a lot of people talk about down payment. They think maybe, okay, I only need 3% down, 3.5% down to buy a house, but there's more that goes into it. Think about when you have a rental too. Like, it's not, you don't just walk up to somebody and say, hey, I'm going to start renting your house. I'll pay you first month's rent when it's due. Like, no, that's not how it works. You kind of pay some stuff up front. They want a security deposit. They want a first and last month's payment of rent, rent. So they want some money up front. So it's the same thing. You have your down payment, which we talked about. That's your initial equity in the home that you're establishing. So that's the percentage of a home you own. You have additional closing costs, which includes prepaids and escrows. So tell people a little bit, they know what the down payment is. What are those additional closing costs? And one of the largest parts of those closing costs really is their prepaids and escrow, which is their own money just being set aside for the future. So talk about that a little bit, prepaids and escrow.
So, I mean, closing costs is kind of an ambiguous term. So let's break it down a little bit. The largest portion of that typically is going to be your title fees. You're always going to have to get a title search, title insurance when you're getting a mortgage. Then there's going to be third-party fees. These are not our fees, but they are fees necessary to complete the transaction. Like, again, like your appraisal, your credit report, stuff like that. Then you're always going to have, well, it depends where you're purchasing. I suppose in Pennsylvania, whenever there's a transfer of real estate, both the seller and the buyer, they pay 1% of whatever that purchase price is towards their cash close. So as the buyer, there's another 1% that you need to come up with, for the government. Then, of course, when you're buying the property, you need to have homeowners insurance. Homeowners insurance is paid upfront. Then your taxes. We want to make sure that we have enough money accounted for so that you have enough money in your escrow account to make sure that you're up to date with your taxes. And also, it really kind of depends, like how the previous, there's a lot of moving parts. Really depends on how the previous owner paid for their taxes. Did they pay for it in full? Did they pay for it in installments? And then also, when are you closing? So we like to do a more conservative estimate to make sure that we have everything accounted for. But that's going to be the escrow portion of your taxes and insurance, all wrapped in for your total final cash to close. So your down payment, closing costs again, and your escrow build.
Awesome. And yes, that escrow account, people ask this a lot of times about their escrow account. Like, okay, it's my money in there. Well, all right, what happens when I eventually sell this house or I refinance my loan, get a new mortgage? Do I get that money back? Yes, that's your money in that. The escrow account is just a third party account that's like being held, but it's your money in there. So it's like they take that money out, the servicer, they take your money out and they pay your bills on your behalf with your own money. That's all it is. So your taxes and your homeowner's insurance. So every year, like I get an email, you get an email, you own a house. Like every year you get an email from the person who's servicing your mortgage. You're making payments to them. And every month you're making a little chunk, a little payment of your mortgage payment is going towards your escrow account so that you don't even know. But whenever your property taxes are due, they just pay them. So they're going to send you an email, say, hey, Nicole, how's it going? Just to let you know, heads up, we paid your property taxes for you using the money that was in your escrow account. I'm like, great. Thank you so much. My life moves on and I didn't even have to do anything. Okay. Last thing here. I've loved having you, by the way, Andrew Keller.
Love being here.
I feel like, yeah, this is a long time coming. So I'm excited. And, oh, wait, one more question we have. What if you co-signed for your sister's house 2 years ago? Okay.
What's the question?
I think it's an older question. So someone's asking, what if you co-signed for your sister's house 2 years ago? That would mean you're on the mortgage. So you have a mortgage. That's, if you signed 2 years ago, all right, maybe the question is phrasing like this. When we were talking about like taking on more debt, if you co-signed for the house 2 years ago, maybe she sold the house since and you don't have that mortgage payment, then you're fine. You're fine. But if you co-signed for your sister 2 years ago, that's still part of your debts. You might say, oh, but I don't live in the house, blah, blah. Doesn't matter. We still got to count that towards your debt. So that's just something to think about. I've also had people not be qualified because they co-signed for a car payment, a car loan for their family that the family did not pay. That will mess up your credit. So be careful who you co-sign for. It's very important. You might not think about it today. It might not matter for you, but 2 years from now, you go to try to buy a house, you need your credit in good standing. Like you said, that seesaw. We need to see that you are able to repay credit. So if you put your credit out there on the line for somebody and they are not able to repay, now it's a bad reflection on you in the eyes of the credit bureaus. They say, oh, that guy Andrew, he can't repay. He's always late. We can't lend him any more money.
I don't think I would say that.
You would never co-sign for a family member who would not repay their auto car loan.
Absolutely.
Yes, be very careful. Last thing here is wire fraud. Very important. We want to protect you. So what is like wire fraud? Tell people that.
So, I mean, unfortunately, in our business, there's a lot of unscrupulous people out there, and one of the parts when you're getting your credit again is is we do the hard pull. And unfortunate part about that is that the credit, not the credit bureaus,
companies like that.
Yeah, the service or the credit agencies, they'll sell your information. Okay, so you want to be careful about who you're picking up the phone for, because they're trying to get your information. They're typically, I don't want to speak bad about any loan originators, but like these people are kind of, and you don't know who they are. So some of these people could be unscrupulous people that are trying to get your money. So you have to be mindful of that. And, especially with emails that are going out, if you see an email that's suspicious or even any email that suggests wiring any funds whatsoever, make sure you reach out to your loan originator, your real estate agent, your title rep, your whole team that's here to protect you, because unfortunately this has happened. It does happen where people will try to extract those funds from you. And when you send that wire, that money it's out there, it's
can't get it back.
Very difficult, if not impossible, to get it back for sure.
Yep. So you want to make sure that you are always verifying. Look, we're the loan officer, the mortgage advisor. We're going to tell you who your title. You're going to know who your title company is. The title company is handling the legal side of your transaction, all your documents, making sure that you actually own the home on paper. They're going to collect the wire and they're going to send you instructions. So only accept instructions that are secure and encrypted. You'll see the emails. They'll say this is a secure encrypted email, and just get on the phone and call them. We usually give their name, their email address, and their phone number. Just call them up before you say, hey, verifying that this is the address. This is where it should go to before just like sending the money. Or you could not wire the money at all, and you can just get a big old check. It has to be certified check, cashier's check from your bank, and just physically bring it to closing.
What do you mean? You mean like one of those checks on like the sweepstakes? Big old check?
You have won $30,000. Yeah. That would be kind of funny for someone to show up with that to closing and be like, here you go. All right. So that's all we got. Any further questions, leave them in the chats. Leave them in the comments. We'll get to them later on. But this will be forever on Instagram. So if you're watching back after it's live, if you're watching back and you have questions, you can always put them in the comments, or you can DM us. We'll make sure you're tagged, Andrew. And thank you to everyone. And thank you to you.
Everybody. Appreciate it.
We'll be back, just as a teaser. We'll be back not next week, but the week after. So next week, I will have another special guest. It'll be a homeowner who has bought a house sharing their story. And then the next week after that is Tuesday, the 26th. We'll be back live with our trivia raffling off to a charity of the winner's choice. Can't wait.
Beautiful. Stay tuned.
Awesome. All right. Well, have a great night, everyone. We will see you very soon.
Take care, guys.